So we are starting this topic, hedge accounting under IFRS 9. Okay, so let's first say there is a word which is called hedge. Okay, hedge means to protect. And what we do, we call it hedging. Okay, and then you have hedge accounting. Now remember that hedging and hedge accounting are two different things. Hedging, all entities they do. Why do you do hedging? You do hedging to protect yourself. Hedge means to protect. Okay, the word hedge means to protect. So you do hedging to protect yourself against some risks which may appear in future. Risks could be related to changes in interest rates. They could be related to changes in exchange rates, maybe commodity prices. So you have some future transactions which you anticipate. You might have to pay someone, you might have to receive from someone in a foreign currency. You might have to take some loan in the future and you are afraid that interest rates may go up or may go down. And to protect those risks, if you remember, you use derivatives. We have done it so much, derivatives, forward contracts, futures and options and swaps. So when you use these derivatives to protect your risks, you call this process as hedging. So hedging everyone is doing. Hedging is not a bad thing. It is, I mean, this is something which makes sense. But hedge accounting is a different thing. Hedge accounting means, are you going to take it or make an accounting treatment of that hedging process or not? Hedge accounting is not a compulsion, which means that a business which is doing hedging, that is fine, but they may or may not follow the hedge accounting. So hedge accounting is not a compulsion. There were two standards, our previous standard IAS 39 and the new standard IFRS 9. Both of these standards, they make hedge accounting, it's a choice, it's an option. Okay, now if it is an option, if it is a choice, then why do we do it? I mean, if I have two options, take A or take B, and I say I'm taking A, I must have some rationale for that. I must have some logic for that. If there is only one offer, I have to accept it without any reason or rationale. But when there are two options, like do hedge accounting or don't do hedge accounting, and you say, I'm doing hedge accounting, or I'm not doing hedge accounting. So you are making a choice. You must have some reason, some logic behind that. And this is what we are going to discuss now. So why do we do actually? So it says it's not only about hedge accounting, it's about hedging. Why do we do hedging? We do hedging to protect ourselves against risks which are associated with the foreign currency exposures, interest rate exposures, or commodity exposures. Commodity exposures means that you have to, sell something or buy something in future. I gave example that let's suppose you receive an order from Levi's for manufacturing or supplying them 1 million denim jeans after 6 months, maybe in March 2022. And you are thinking that you have to give price to Levi's now. You have to make a contract with Levi's now. Maybe the contract price you want to settle at $22, and that $22, it includes some price, some cotton, which is one major raw material in denim jeans. You saw what is the price of cotton today. It is $6. Whatever quantity you are using, $6 of cotton will go to within one denim jeans. In March 22, cotton prices may go up. If they go up, the quantity of raw material will go to $8. You will be losing $2. So what you need to do, you need to today, when you are signing a contract with Levi's, at the same time, you need to sign a contract for the purchase of cotton at a certain price in a future date. So commodity exposures you are facing. Same happens with airlines. They use huge quantities of fuel. So airlines, they have to protect themselves against the changes in future because they are buying air ticket. They are selling air tickets in future. You can buy an air ticket for 3 months from now. Okay. So when they are giving you a price for 3 months from now, on the date of that particular flight, what would be the price of fuel? So airlines, they are always buying how to say, fuel in the future date by at a fixed rate to protect themselves. So this is the purpose of hedging. We understand that. And what happens? Why do we do that hedging, by the way? Okay, let me go there, see what is there. Okay, so in hedging, what happens that let's suppose that I have to, let's say the same thing which I say buy cotton, okay? Buy cotton. So I'm sitting in the middle here. This is a cotton supplier. This is the market price of the cotton. I have to purchase cotton in the market, how to say, 6 months later. Cotton prices may go up or may go down. And as a result of going up or going down, I might make a gain or I might make a loss. So to protect this gain and loss, which I may face here, I make another contract. I make a forward contract or or a future contract, whatever, a derivative. I will go for a derivative. Maybe I buy some futures or whatever. And what happens that when the cotton prices, if I make a loss on this transaction, if there is a loss, this transaction, I will make a gain. So they will offset each other, but they do not offset each other exactly. It is possible that I make a loss of, I don't know, 100K, but then the derivative moves in the opposite direction. So as the cotton prices are going up, my contract prices are going down or otherwise. So what will happen that I will make a gain here. That gain might be 60K. So it is not covering all of my loss, but at least it is giving me some relief. It is covering some of my losses. So I have got a derivative here, a derivative contract I made. This is my actual transaction. And this is my hedging transaction. And the purpose of doing hedging transaction is that if you make a loss here, you might make some gain here, and you could, neutralize this loss to some extent. So this is how it works. You've got a host contract. Host contract is your actual transaction. For example, we have been talking about interest rate risks. You need to take a loan after 6 months, okay? You need to take a loan of $100 million after 6 months. You expect today market interest rates are 5%. Today it is 5%. You are afraid that in 6 months' time, they may go up. You cannot force your bank to give you at 5% in 6 months' time. Bank will say, come after 6 months, whatever will be the spot rate, whatever will be the market rate, I will give you. So then what you do, you make a future contract for interest rate, probably at 5.5%. Probably at 5.5%. So then what happens when the time comes in, this thing goes to 6%, and you think that you are making a loss of 1%, but then you make a gain from this transaction because you have a 5.5, market value is 6, your contract is giving less. So you can sell this derivative. This derivative price will go up. The future price, this future which you have, these futures which you have, you purchase them for a certain price, this price will go up. So you will sell your futures separately. You will sell your futures. You purchase futures for X dollars. Now you will sell futures for X plus Y dollars, and you will make a gain of this Y dollars. And whatever loss you are making here on the interest rate, that loss somehow is canceled out with the effect of this gain. It is possible that it would never be equal to, you would be hardly seeing this thing that I make a loss of 100K and then there is a gain of 100K. It wouldn't be exactly the same amount, would be more, could be less. So this is the idea that I need to counter the effect of one transaction. So this is my transaction. I want to protect this transaction. To protect this transaction, I used another transaction, and that transaction I used a derivative. By the way, there could be non-derivative items as well. What could be those? We will discuss them later, but mostly we are using derivatives. Non-derivative items can also be done, but generally we use derivatives. So this is the process, okay? You've got a main transaction in future. To protect this transaction, you make a counter contract, and as this, or you are losing money there, you are gaining the money there. So they move in the opposite direction. So this is how this hedging thing works. Three types of hedges we do. What type of hedges we do? We call it cash flow hedge. We call it fair value hedge. Cash flow hedge is this reduces the risk of changes in the fair value in the future cash flows. So if I'm telling you the example of interest rate risk, that was an example of cash flow hedge, because cash flow hedge you do for those items which will impact or which possibly could impact your cash flows. Remember that I anticipated, I mean, if interest rates, they move up from 5 to 6%, I have to pay more interest. If they move up to 7%, I have to pay more interest. So my cash flow is being impacted. I want to protect my cash flow. To protect my cash flow, I use cash flow hedge. You might have fair value hedge. This reduces the risk of changes in the fair value of existing assets and liabilities or firm commitments. Three words we use: existing assets, liabilities, or firm commitments. I will explain you. For example, let's suppose that I purchase a bond, okay? A bond which is for $100 and which is giving 5% return for the next 3 years. And this bond has a market value. Let's suppose today the market value is 105. But I know that if the market interest rates, they move up or they move down, this market value of the bond can go up or can go down. So I don't want this to be go down. I mean, I have a fair value of 105 in my books. I want to protect this 105. So if I make a hedge against this situation, I'm actually going for a cash flow, a fair value hedge, because I'm trying to protect the fair value of the bond. Okay, so assets, if you purchased a bond, it is your asset. If you have issued a bond, it is your liability. So you can do hedging for both of these. And then you have firm commitments. Firm commitments means that these are not your assets or liabilities in your books. They are not on your balance sheet, but you have some contracts for purchasing. Like I told you that I make a firm commitment to purchase 1 million bales of cotton. I have a firm commitment to purchase, because I've placed order to my supplier to, supply me, 1 million barrels of oil. So firm commitments you also want to hedge using fair value hedge. And then you have net investment hedge in foreign subsidiaries. So this is a case where you have investment in some other foreign subsidiaries. They have assets and liabilities on the balance sheet of those subsidiaries. End of the year, because it's a foreign subsidiary, they might be preparing their financial statements in a foreign currency. And then at the end of the year, when you translate those assets and liabilities, then you might face risk. End of year 2008, you had some value of assets which were 100 million euros. You converted them into your books at, $110 million, let's suppose. In 2009, you expect that there will be a change in the exchange rates. And probably even it is 100 million, even if it remains 100 million, there is no change in the assets as such. You didn't make or lose anything. But because of that conversion, it might become, $105 million. So you are actually, the business did not lose any money, but your net assets in the foreign subsidiary have gone down just because of this exchange rate differences. So these are the three things we say: cash flow hedge, fair value hedge, and net investment hedge. So far, I am only speaking about hedging. Hedge accounting is a different thing. So this is what I'm speaking about is hedging, what type of hedges you do. And like I told you that when you do hedging, what you can consider that hedging is something which you do in general. This is your choice. And it shows the seriousness of managers against the risks, the risk management strategy. And hedge accounting, you can consider it as making your hedging process official. Okay. In a very layman terms, I can say that if I'm doing hedging, it might be considered as an informal activity, let's suppose. But when you do hedge accounting means that you are officially recognizing that hedging process in your books of accounts. Why use hedge accounting? Now, why use hedge accounting? Why do you use hedge accounting? Okay, so we'll go into details. But before going into detail, I'll give you a very simple answer. You do hedging. This is not an issue of accounting, okay? I am doing hedging. This is part of my risk management strategy. This is the job of the risk department. And then you can do hedging without hedge accounting. Let me write it down like in short, without hedge accounting, or you are doing hedging with hedge accounting. Now, if you do hedging without hedge accounting, you are not adopting hedge accounting. Any gains and losses which you will make on this transaction, gains and losses which you will make, they will go because you already have the instrument. You have got the instrument. You have already done the hedging process. I'm not questioning that you will do hedging or not. Hedging you already have done. You already have made the contract. You already have purchased futures. So gains and losses are possible. And these gains and losses will go to P&L straight away. So that's very simple. So, and you know that if you remember management's perspective, IFRS perspective, and the treatment within P&L, you know, charging things into P&L is never our wish because it makes my P&L very volatile. Sudden gains and losses are going into my profit and loss account. I don't want that. Remember that throughout the discussion, OCI part. If you do hedge accounting, so this is the same hedge which you already have purchased the futures. You have already become party to a hedging arrangement. And you decide that let's make it formal. I'm going to do hedge accounting. Now, how do you do hedge accounting? I'm going to explain that. But you say, I have this hedging arrangement and I am going to use hedge accounting. So in this case, again, you will have the same gains and losses. But this time, these gains and losses will be split between OCI and P&L. So this is the difference. This is the difference. Because when you use hedge accounting, it gives you an option to take some part of gains and losses into P&L and some part you take into your OCI. So there is, we call it effective portion of gains and losses and ineffective portion. So you will take your effective portion in an ineffective portion, you split it between OCI and P&L. And this is, I'm going to explain how to calculate effective and ineffective portion and what is effective and ineffective portion of loss. You've got a total loss. Let's suppose that you have a loss of 100. So you split this loss into effective and ineffective, and some of that will go to OCI and some of that will go to P&L. And that gives you a relief. Now, remember, hedge accounting is not going to change the economic reality. Hedge accounting is not going to change my gains and losses. I do have 100 because this is the same transaction. This is the same transaction. $100 loss has incurred. I mean, transaction is same. Reality is same. Numbers are same. It is only about the presentation and the accounting treatment. If you are not doing hedge accounting, all of this 100 will come to P&L. But if you are using hedge accounting, you have an option to split it between effective and ineffective portion and then take some part to OCI and some part to P&L. And by the way, there is one exception if you remember. Means I said that everything will go to P&L. But there is just one exception. And that one exception was equity instruments. I'm smiling here because we discussed this thing a lot. Equity instrument at fair value through OCI. Remember that irrevocable election you made? Equity instruments, usually we'd say fair value through P&L. But if you have irrevocable election of fair value through OCI, which was a very special case, so those gains and losses on those equity instruments, they will also be going to OCI. They will also be going to OCI. Otherwise, everything else will go to P&L. So let me conclude. If I am not using hedge accounting, all gains and losses will go to P&L, except the gains and losses on equity instrument held at FV OCI, because that was a special category. We assigned it under very strict terms and conditions, so it remains at OCI. And what happens in case of when you are not doing hedge accounting and everything goes to P&L, so P&L becomes very volatile because it will take all the shocks. It will take all the shocks. And we actually do not want our P&L, profit and loss part, to be very volatile. We want something to go to OCI. This is the first part of this thing. Are we clear on this thing? Rajesh, Janish, Joseph, am I clear on this first concept? Kamlesh? Let me see you guys are there or not.
Yes, sir.
Okay. Thank you.
Yes.
Thank you very much. Okay, so why use hedge accounting? Hedge accounting is all about timing. Now, what does that mean? Why do we say timing? See, what happens? You have a financial reporting date. You have reporting date for financial statements. And on that particular reporting date, which might be 31st of December, you have your derivatives or any hedging instrument, whatever you have. You have to find out its value, fair value, on the reporting date. Okay. And any changes in the reporting date, they will be gains or losses, and they would be reflected into P&L. So what will happen here? Now, what I'm trying to explain you, remember that you have two things. You are Alpha company, you made a contract to purchase cotton, and then you made a derivative to protect here. Okay. So this transaction is going to be realized on 28th of February. So gains and losses will occur on 28th of February. And this is the derivative. And you are actually closing your books on 31st of December. So any gains and losses are here occurring on 31st of December. So now what happens that some part of gains and losses are, on one instrument, on one transaction, it will happen in next year. On one transaction, it is happening in the same year. So there is an accounting mismatch. I call it an accounting mismatch because one transaction is being reported at 31st of December and I'm putting it in 1 year. Another transaction will be realized later on and the gains and losses will happen in the next period. So if this is the situation, then hedge accounting is your solution. If this is the situation, then hedge accounting is very much relevant when you have gains and losses from the two transactions in two different periods. But if you have gains and losses within the same period, from the both transactions within the same period, then hedge accounting does not really matter. Why it not really matters, I will explain it slightly later because it will open up another debate. When I will tell you about effective, ineffective portion, I will answer to this question as well. So you should remember only here now that hedge accounting is only relevant when you just want to match the timing, when gains and losses from two transactions are happening in two different periods. If they happen within the same period, then whether you do hedge accounting or you don't do hedge accounting, nothing will change. Because remember, you have a loss of 100. Hedge accounting is not going to decrease this loss in any case. You have a derivative, okay? You have a loss here on actual transaction. You have a derivative here, which give you a gain of 30. Okay, so your net impact is 70 loss. Whether you do hedge accounting or you don't do hedge accounting, this net impact will not change. Only the presentation will change. And that presentation will also impact only when it happens in different years. If it happens in the same year, then without hedge accounting or with hedge accounting, you get the same result. Okay. It doesn't change the economics of the underlying hedging transaction. Yeah, like I said that, the numbers on the ground do not change. With hedge accounting, the goal is to match the recognition of the derivative gains and losses with the underlying investment gains and losses. Match them. Match them means put them in the same period and put them into the same financial statement. So I have got, for hedge accounting, to do hedge accounting, I have two reasons. One, timing, if there is a timing difference. And number two, the financial statements. For example, it is possible that one transaction is going to be reflected in a different statement, another is in a different statement. For example, one is at fair value through P&L, other is fair value through OCI, or one gain and losses are going to P&L, another gains and losses are going to OCI. So these are two mismatches, a timing mismatch and the presentation mismatch. To solve these two things, I am using hedge accounting. Otherwise, I don't need it. The ability to match these in the same accounting period and in the same financial statement is the real benefit of hedge accounting. So the real benefit of hedge accounting is that you are matching them in the same period and in the same financial statement. Purpose of hedge accounting. The objective of hedge accounting is to represent in the financial statements the effect of risk management activities. Okay, now here we say effect of risk management activities that use financial statements to manage exposures arising from particular risks that could affect profit or loss or OCI. So purpose of hedge accounting, it tells that the management is serious about risk management. It has taken measures to manage risks, and it shows the impact of risk management activities. Like this is, why did I write this 3 points? Because you might get a 3 or 4 point question in exam. A discursive question could appear that what is the purpose of hedge accounting or why hedge accounting is done. So 3 things you should be mentioning. One, that the manager understands, or you can not say serious about, let's say management understands the importance of risk management. They are taking measures to manage the risks, and it shows the impact of the activities of the management, the impact of the strategies of the management about the risk management. So 3 points you should be referring to. Hedge instrument and hedge items. Now we go back to some vocabulary. Actually, I've already moved very much because these are very basic things. I've spoken actually more than what we are here. So hedge instrument and hedge item. So hedge instrument is that instrument through which you do hedging, and hedge item is the item which you want to protect. For example, the example which we took, for example, we had cotton and we had our futures. Or you might have some interest rate or foreign currency or futures. So cotton is my hedged item and future is my hedging instrument. So I've got a hedging instrument and I've got a hedging item. And there should be a relationship between. So you've got hedge instruments like derivatives. Within derivatives, you have future forward. And you might have non-derivative instruments as well, which I doubt that they would give an exam, or for academic purposes. Non-derivative instruments are generally not there, but there could be. You use hedging. You can do hedging through non-derivative instruments. For example, you invest in somewhere else. And then you've got hedge items, foreign currency, interest rate, and commodities. We already discussed it before. Criteria to apply hedge accounting. So these are the conditions. Now, before I start coming here, let me tell you, If we compare IS 39 and IFRS 9, the old and the new standard, although IFRS 9 has given you many different things like classification of assets, and then biggest thing was an impairment, but hedging has not changed a lot. I would say that 80% of the concepts are the same. Terminology is same, concepts are same, mostly criterias are same, few conditions they have changed. And those conditions, they go into quite a lot of technical details like partial hedging and etc. and on non-derivative things. So 2 or 3 changes are there, but they are in so much detail that they apply in the real life, but you probably might not be seeing it for academic purposes. For academic purposes, you can consider that as far as hedging is concerned, IS 39 and IFRS 9 are almost similar. So all criteria must be met. What are the criteria to apply hedge accounting? Like if you want to use hedge accounting, so what are the conditions? Number one, that there should be a hedging relationship between the hedged item and the hedged instrument or the transaction. So hedging relationship should exist, which means one goes up, the other goes down. And it must consist of eligible hedging instrument and eligible hedged items. Now, eligible hedging instrument, which instruments you can use to do hedging, and which items you actually can hedge, and which items you cannot hedge. For example, you can hedge the value, the fair value of share, okay? Fair value of shares, equity shares, you can use hedge for that. You have got some shares in some particular company worth of 10 million, and you are just afraid that the price goes down. To protect yourself, you can use fair value hedge for that. But you cannot protect your own shares. So own shares hedging is not done. That is not eligible. Similarly, stock market index you cannot hedge. Stock market, different shares, individual shares you can do, but you don't do hedging on index. Stock market index we don't do. So there are eligible hedging instruments, which instruments can be used and which items can be hedged. So designation and documentation is important because like I said before, that when you decide hedging, you are doing in any case, but when you decide to do hedge accounting itself, then you need to have proper documentation for that. It should be visible in the corporate strategy. It should be part of your risk management strategy with proper documentation, must be formalized at the inception of the hedging relationship. The hedging relationship, risk management strategy, the objective of undertaking the hedge, what are you going to mention, and the hedged item and the hedging instrument. These things you will mention. And that's what we say, that the purpose of hedge accounting, that it shows that management is taking measures, and what measures they are taking, what is their strategy, and what is the impact, and how hedge effectiveness will be assessed. Now, hedge effectiveness, again, effective and ineffective thing, I'm going to discuss it slightly later, but this is where you were having a different rule in IS 39 and IFRS 9. So assessing the hedge effectiveness is different in IFRS 9 than in previous standard. Of course, I'm not going to explain previous a lot, but I will speak a little bit later. But here there is a change. Now, how do you measure? I'm going to explain. Don't worry. All 3 hedge effectiveness requirements must be met. So what are those requirements? Number one, an economic relationship exists between the hedged item and the hedge instrument. For example, if the cotton price goes up, the price of the derivative of that hedge instrument, it must go down or something. There should be a relationship there, which will prove or which will show that if there is a loss on one side, there should be a gain on the other. So economic relationship must exist. Credit risk does not dominate changes in value. The risk on that hedging instrument cannot be more. It should not more than the host contract. The changes on that side should be less. It should not be dominating the actual transaction. And the hedge ratio is the same for both the hedging relationship and the quantity of hedged item actually hedged. Hedge ratio, what is that? I'm going to explain you slightly later. Let me go back to the next topic part when I will explain hedge effectiveness. I will speak hedge ratio there. So three conditions you have here, and all these three conditions must be met. Now, what are eligible hedging instruments? So far, we already have covered. I'm sure that only those from contracts with external parties of the entity. So within the group, hedging is not possible, because hedging means that you are diversifying the risks away. Hedging means that you are transferring the risks away. So if you make an arrangement within the group with some subsidiary, it means that the risk remains within the group. So that is not a hedging arrangement. The purpose of hedging arrangement is you get rid of the risk. Derivatives measured at fair value through profit or loss. So this excludes written options unless they are designated as an offset to purchased options. So written options are not eligible hedging instruments, but otherwise derivatives are. And non-derivatives are also possible, measured at fair value through profit or loss. And by the way, these items which are measured at fair value through profit and loss, you should pay attention. Derivatives and non-derivatives. We will be focusing more on derivatives because this is most common type of hedging. Non-derivatives is possible, but these are rather less. Eligible hedged items. Eligible hedged items are three things: assets, liabilities, and firm commitments. You call them firm commitments. Firm commitments are highly probable forecast transactions. And net investment in foreign operation, we will discuss. We have already spoken about it. Hedges of a group of items. It is also possible that group of items together you do, and all criteria must be met. All item and components are eligible hedged items. This is not really very much for academic purposes. It is quite a little bit technical on the practical side of that. The items are managed as a group for risk management purposes. Group of items. Sometimes what happens that you are facing risk, okay? Why do you do hedging? You do hedging to avoid the risk. And risk might be coming from different sources. So we talked about an example of fuel, okay? Oil. Like when we say commodities, the first thing which comes to mind is fuel. And the prices of fuel to you or for you, they go up for different reasons. Number one is probably you have a different currency and you are purchasing fuel in dollars. You have got a currency which is AED, dirhams. So maybe in the market, the fuel is $70. Market is says $70 per barrel. Market is still 70. But what happens? That your exchange rate changes. So before there was a different exchange rate. For you, $70, it meant 210 dirhams. But because of the exchange rate now, $70 means 240 dirhams. So you see, you are facing risk, not because of the changes in price, but because of the changes in some exchange rate. So this is one risk which is coming to you because of the exchange rate. Now, there is another option that this 70 also does not become 70, it becomes 75. Market has also gone up and exchange rate has also changed. So now you are actually facing this rate, market price risk also you are facing. So two types of risk now you have taken. So by the way, this is actually one of the differences. IS 39, it requires you that if you are making a hedge against fuel, you should be making hedge against both of these items. This was the requirement of IS 39. You have to make the hedging arrangement in its totality, in its total transaction. IFRS 9, on the other hand, it allows you to protect yourself, because you know that if you are going to protect two things, one is I want to take a contract for the fuel price, and then I want to take a contract on exchange rate. So I have to make two contracts, and that might be costly. I am worried about the exchange rate. I may not be worried about the price, or I may be worried about the price, but I'm not worried about the exchange rate. But IS 39, it said to me that you have to make a total arrangement. Whereas in IFRS 9, I can pick up one. I'm not worried about exchange rate because my country, my government is doing really good on exchange rates. They are managing exchange rates. In most of the Middle Eastern countries, you see that they've got very stable exchange rates. They are not free floating. They are managed exchange rates. I mean, if you see, Saudi Arabia, it is like a straight line. It is a straight line. They never allow it to move up and down. They are not bothered about this thing. Yeah, they might be bothered about the prices. So it depends. So IFRS 9 allows you to take a partial thing. So you might be doing for a group or you might be doing for a partial thing, and partial is allowed here. The items are managed as a group for the risk management purposes. Items 2, risk and exchange and prices. For group cash flow hedges, where cash flow variability is not expected to be approximately proportional to the overall group cash flow variability both. Okay, it's the same concept. So designation, an entity can designate a hedged item in full or in part, like component, like only the market price. If in part, only the following types of parts of hedge item can be hedged. One or more selected contractual cash flows, like the prices or whatever, or exchange rates, and parts components of a nominal amount. Separately identifiable and reliably measured changes, cash flows or fair value. So you can measure, like, for example, if I say that today market price is $70 and one dirham and AED and dollar is like 3. So it means that I have to pay 210. But if it moves to 3.5, I might be ending up paying for 70. I have to pay for, I don't know, 280, let's suppose. But if this also moves to 75 and this remains 3.5, I have to pay, I don't know, 320. So I can actually separately identify that how much cash flow is being impacted by a change in the price or by a change in the exchange rate. This is what we say separately identifiable and reliably measurable changes in cash flows or fair values that are based on the context of the market structure, which are attributable to a specific risk, attributable to a specific risk. Which risk? Risk in the market, changes in the market price, or risk in the changes in the exchange rates. Now comes types of hedges. So we speak now types of hedges. We discussed in the first slide 3 types of hedges we have: cash flow, fair value, and net investment in foreign subsidiary. Let's see the cash flow hedge. So criteria: hedge of exposure to cash flow variability in cash attributable to a particular risk associated with an asset, a liability, or a highly probable forecast transaction. Highly probable forecast transaction means, for example, which example I gave you, that we are planning to take a $10 million loan in 6 months' time. And if the interest rates, they go up, my cash flow will be impacted because I will have to pay more cash to pay the interest. That's a cash flow hedge. I need to make cash flow hedge for that. Recognition: you see hedge effectiveness is recognized in OCI and ineffectiveness is recognized in profit or loss. Now, because you are doing hedge accounting, so like I told you before that your total loss, let's suppose your total loss on the transaction was $100, which is net of the two things. Okay, let me write it down again. Let's suppose that you have here, okay, let's keep it simple. If you have a $100 total loss, some part is split between OCI and something goes to P&L. Effectiveness goes to OCI. So effective part of the hedge goes to OCI and ineffective part goes to P&L. Now, and let's suppose I say that effective is 30 and ineffective is 70. So it means that in P&L, I'm putting 70, in OCI, I'm putting 30. So I'm putting my loss only $70 in P&L and $30 in OCI. This is with hedge accounting. If there had been no hedge accounting, then all of the $100 would have come to P&L. This was the purpose of doing hedge accounting. Now, the question is that how do you separate this thing, $30 and $70? How do you differentiate between effective and ineffective portion? Now, this is the point where IAS 39 and IFRS 9, they made a difference. In IAS 39, I'm not going to explain in detail, but I will just tell you the basic thing. There was a rule, we called it 80 to 125%. So anything between the total loss we took and we say the probable, and the range of 80 to 125 was effective. The beyond or more, if it was less than 80%, more than 125%, we said that it is ineffective. So there was a percentage which was given, and that required quite a lot of calculation. You find out the total loss, then you started doing calculation, 80%, what comes within this range of 80 to 125. If it is here or there, this is ineffective. This is here, this is effective. So anyways, that required calculation. This is no more there. We don't need to do 80, 125% thing. Rather, what we say that what is effective and ineffective portion. So the amount of loss or gain, which is counter set, which is, set off by the instrument and which is by the, for example, if I make a total loss, not total loss, I've got transaction here and I'm using the same thing. This was my actual transaction on cotton and I suffered a loss of, I don't know, let's call it 130. But then I had a future contract and that made a gain of, let's call it 50. Okay. So it means that this, whatever loss is here, some of that loss has been offset by my hedging arrangement. So it means that my hedging was effective to some extent. It was an effective tool, it was an effective measure, and it did its job. It decreased some of the loss. So how much loss was set off by this? 50. This 50 is my effective portion, and 80 is my ineffective portion. Okay. And ineffective portion, what is not covered. So you did a strategy. Now you will also ask me, why do you put ineffective in P&L? And I will give you an answer. I will not say that just remember it. We will give you an answer. So first of all, you remember that whatever gain or loss is offset by the instrument, which means that your hedging strategy was effective. It was only effective up to $50. So it was only effective up to $50 because it recovered $50. So $50 is the effectiveness of the hedge. And effectiveness goes to OCI. And ineffective goes to P&L. Why ineffective goes to P&L? I can ask you that you might have your, if you had been a very good, if you had a very good hedging strategy, you should have achieved this thing, hedge effectiveness, that there is a loss of 100 and you make a gain of 100. So if they offset each other, that should have been fine. But you took the decision of doing or using some hedging instrument. Okay, this was 130, okay, which is making a loss of 130, and you took an hedging instrument which only made $50 gain. So this 50 fine, but what about this 80? So you are responsible for this 80. Are you not responsible for this 80? If I were you, probably I would have taken something like this. So let's take it into P&L. So remember management's decision, the gains and losses which are within the control of the management, which result as a decisions the management take, they go into P&L. And that's why I'm putting ineffective portion into P&L, because P&L is the part for which you take the claim. P&L is the part for which you are responsible. And I see that you are responsible, your responsibility goes to 80. So two things we understand here. Number one, we learned that if you have a total of, I don't know, 130 or 80, you split it between the effective and ineffective portion, like 50 is my effective and 80 is my ineffective. And then ineffective goes to my P&L and effective goes to OCI. How to find 50, 80, we already know. Now, here the question comes in. Here the question comes in. The most important concept which you should be thinking in your mind. Remember, I told you that we use this thing, hedge accounting, when there is a timing difference. And I said that if both the transactions, the host contract and the hedging transaction, they materialize in the same year, I said then hedge accounting does not bring you any benefit. It becomes irrelevant. This is I said, and I said I will explain you later. Because let's suppose that this is my time period and I am maturing this transaction. One transaction happens here and I made a loss of 130. Other transaction also is balanced out here and it gives me 50. And both transactions materialize in the same year. So if you have, when it is realized, when the transactions are realized, where do they go? Do they go to OCI? No, they go to P&L. Realized transactions are recycled to the P&L. So whether you do hedge accounting or you don't do hedge accounting, ultimately what will happen? So if I have hedge accounting, let's suppose my line is here. Let's suppose that my line somewhere is here. If I'm doing hedge accounting, this is my PBIT, profit before interest and taxes, and I will put my $80 there, and I will put my $50 here, let's suppose. This is how I'm splitting. Okay, this is in the case of hedge accounting. If you don't have hedge accounting, you put 130 there, all of that in P&L part, and nothing goes to OCI. This is without hedge accounting, this is with hedge accounting. But if the both transactions are realized in the same period, then it does not matter, because nothing will come here. It will also be transferred there. Because you will say that, Mr. Ali, if I am making a loss of 130, if I'm making a loss of 130 and it goes to my P&L, and then there is a derivative on which I make a gain, this is a loss. And if I make a gain on my derivative of 50, that also goes to P&L. So what is the difference? The difference is the time frame. If it is within 1 year, both will automatically go to P&L, and hedge accounting, doing or not doing, will not make any difference. It will only make a difference when you have two different time periods. Because you remember in OCI, you put unrealized things. In P&L, you put realized thing. If both transactions are matured within the same year, both are realized, ultimately they both will go to P&L. So this is hedge effectiveness in OCI and ineffective portion in P&L. And I have explained you why an ineffective goes to P&L. Okay. This is nothing special. The lower of the cumulative gain or loss on the hedging instrument, it's the same thing which I've explained. Fair value hedge of exposure to fair value variability in an asset. A liability or unrecognized firm commitment or part thereof component attributable to a risk. I mean, definition, but we have explained you fair value hedge. Like I told you, you have some assets, and those assets the value could go down. It could be shares. You have shares and you are afraid that fair value can go down. You have, how to say, bonds, fair value can go down. So gain or losses on hedging instrument recognized in P&L unless the hedging instrument is an equity instrument. So actually, it is all fair value through P&L, but only the equity instruments which have irrevocable election, they go to OCI. I have explained this thing also before. Okay. Hedges of a net investment in a foreign operation. I'm sure that you remember that this thing is the one topic which I have been focusing a lot, because this is an important thing. You know, own shares or equity shares normally on P&L, but if you have an irrevocable election OCI, then gains and losses, they also go to OCI, even if you do not do hedge accounting. Net investment in a foreign operation, we started in the beginning, we discussed this thing. You have a foreign subsidiary, you've got net assets there. Those net assets will be translated back to your own home currency. And because of the changes in foreign exchange, you might be exposed to risk, and you want to cover for that risk. Recognition, hedge effectiveness again is in OCI, ineffectiveness again in P&L. Now, there is one question which will become very technical to discuss here in this class at this level, that what you should be hedging from a foreign subsidiary. All of your assets, net assets, or what? Now, that's I would say it would become more technical. It is not, although I've gone beyond our syllabus. I've already spoken much more things than what you will see in your book. I bet when you will open up your book for IFRS 9, and when you will see my lectures, you wouldn't see any relationship, because book has spoken very little. I've given you a lot of details. But this is something I don't want to go into more detail, that what interests you should be, hedging in a foreign subsidiary, because you have multiple options for that. But that is not the case for us to discuss. Upon disposal of the foreign operation, accumulated amounts in equity are reclassified to profit or loss. Yeah, because we know that once we take them in OCI, effective portion goes to OCI, ineffective goes to P&L. So something remains in OCI. Something remains in OCI, okay? And OCI continues year over year, okay? Then, but when you dispose of foreign operation, so whatever is in this OCI, that will be recycled to your P&L. And this is a very basic understanding. We always know that whenever you materialize some transaction, so whatever is in OCI, that is recycled or transferred to the P&L. And the same rule applies here. Hedges of a net investment in foreign operation. The amount of net investment in a foreign operation under IS 21 foreign exchange. In the reporting entries, interest, including any recognized goodwill as well. Exchange differences arising on the consolidation of these net assets are deferred in equity until the foreign operation is disposed, which means that you keep it into your OCI until it is disposed or liquidated. Once liquidated, then goes to P&L. They are recognized in P&L on disposal. Okay, that's all. Group of entity transactions, group entity transactions, I'll just skip it. Nothing new. Rebalancing. Rebalancing is also something which is new in IFRS 9. It was not allowed in IS 39. You know what happens that, for example, you have this contract and you need to buy cotton here, and to protect you purchase some futures. You made an arrangement, and this arrangement has to be effective. We said that the arrangement between the hedged item and the hedge instrument should reflect the effectiveness of the hedge. Okay. It is possible that for some period of time, after some period of time, you realize that this particular hedging instrument is not delivering or is not protecting you as you should be protected. By the way, remember that usually we do hedging in the short term, but it could be in the longer period as well. I might make a contract for the whole 1 year. That is also possible. Anyways, when you see that this particular thing is not doing something what it was supposed to do, like balancing off. Here there are big changes, big movements, and here there are very small movements. So this hedge is not really going to benefit me. So should I sit down and wait? No, I will try to make some changes, some amendments in this thing, in this transaction. I might change the size of the transaction, I might change the instrument, or I might change something else. So this is called rebalancing. Rebalancing under IAS 39 was not allowed. IAS 39 said that if you feel that this is not working, you have to terminate the contract and actually start a new contract. Start a new contract. A new contract. So rebalancing was not allowed. IFRS 9, it allows you to do rebalancing. So you can make amendments and you can continue with the same arrangement, but you have already made an amendment thing. So if the hedge effectiveness test ceases to be met. So this is changing by, I don't know, a bigger percentage, and there is a smaller percentage here. So you see that it's not being effective, hedge ratio is not met, but the risk management objective is unchanged, which means that you still want to achieve, you still want to manage that risk. An entity adjusts or rebalances the hedge ratio as the criteria is once again met. So you can do rebalancing here. So discontinuation, again, there is a difference in IAS 39 and IFRS 9. Because you know why I always refer to, because IFRS 9 I've been teaching for 4 or 5 years, ever since it was introduced. In 2018, we were started focusing on IFRS 9. But before so many years, for 12 years, we were teaching IAS 39. So every time, whenever I see this thing, this IAS 39 again comes to mind. So discontinuation, like when you do hedge accounting, is discontinued only if the qualifying criteria are no longer met after applying rebalancing. This including hedge instrument sale, termination, expiration, but excluding. And by the way, in IAS 39, when it was not like terminated. In IAS 39, it was like, you know, when it expired or when the right ceased to exist. But here it is possible. These conditions are met. We say that, I'm sorry, where did I go? Yeah. So 2 conditions were there. Let me clear it. So you can do this including hedge instrument sale or termination or expiration, but excluding these things. Replacement rollovers documented in the risk management objective, if you have some risk management objective, and novations of hedging instruments subject to specific criteria. So these 2 are exceptions. Otherwise, you can do instrument sale or terminate or expire. So this is called discontinuation of the hedging arrangement. So overall, what we learned that hedging we do, but hedge accounting should we do or not? The purpose, the only purpose of hedge accounting is to manage the volatility in P&L. Because if you don't have hedge accounting, everything goes to P&L, which means a lot of gains and losses are coming into P&L. So hedge accounting purpose is to manage the volatility in the P&L so that you can take something to P&L, something to OCI. And that will only be applicable when you have a timing difference and when you have gains and losses in 2 different financial statements, one in P&L, one in OCI. Only then you do hedge accounting. Otherwise, the dollar value, the gain and loss in terms of dollars or numbers will not change. That will remain same. And this is the reason that IFRS 9 does not make it mandatory. It is not compulsory that you do it. So it is your choice whether you want to go for hedge accounting or you don't want to go for hedge accounting.